Expert in finance, that's Peter Lazaroff. He's the author of Making Money Simple and Chief Investment Officer at PlanCorp. We thank you for joining us today, Peter.
Hey, thanks for having me.
All right, first off, what's your take on today's jobs report?
Well, generally speaking, even though the unemployment rate fell, it didn't fall as much as people were expecting. And more importantly, we saw that the job gains that caused that fall in unemployment rate are slowing. So we lost 22 million jobs in March and April, and we recovered about 11.4 million of those. So that's great. And certainly this recovery has happened a lot faster than anybody predicted. However, we are seeing initial jobless claims trending higher. We're seeing some of the federal aid starting to slow down and reaching a point where the consumer, which makes up roughly 70% of our economy, is reaching a really tough spot. So I do think that this reemphasizes the fact that the market sort of wants to see some fiscal stimulus step up at some point. And I know that's been the headlines a lot. But certainly, this one data point, this is the last jobs reports before the election. And so now the next, extended period where we have to figure out what is next for the labor market, but certainly the economy not quite growing as strong as it was prior.
News of President Trump testing positive for COVID-19 sent the market into a spiral today. Explain how the markets treat information like that.
Well, so it's really easy to connect one single data point to whether the market was up and down. But in reality, anytime stocks go up, really what we're saying is that the market as a whole, which is millions of very, very well-informed people, and there's some people who are less well-informed, but the people pushing around big dollars, all they're saying when they push stocks higher is that they expect future profits to be higher. And when it goes lower, they expect future profits to be lower. I would argue that while the Trump headline was the big one, there is also, again, these jobless claims yesterday. We saw that personal income was falling yesterday. We had earnings reports out yesterday. There's a lot of different moving pieces, and it's always hard to say that A caused B and B caused C with markets. It doesn't really work that linearly. But certainly, the elections are at the forefront of people's attention. Vaccine development are at the front of people's attention, as is whether or not we'll get some additional stimulus from the government.
In a minute left. We've got the election 31 days away. A lot has been made about how the market might react to whoever is elected. Is all that a bit overblown?
It's absolutely overblown. And there's been academic research to show that there is no correlation between who wins an election and long-term or short-term returns. And what's really interesting is that if you look at data in the 3 months leading up to an election, or the 3 months after an election, or the 6 months after an election, in all cases, on average, you see that the markets are higher. And when you start going out 4 years, 5 years, 10 years, again, the presidency, it's not that it's not important, but it's just one of hundreds, if not thousands, of different factors that goes into future stock returns.
All right, Peter Lazaroff, we thank you for your time and expertise. We'll talk to you soon.
Thanks, Brett.